Today, we're really aiming to build your ultimate toolkit. It's like a shortcut to understanding something absolutely critical in business and finance, financial risk management. We've done a deep dive into an MBA quick revision guide. They're apparently a real goldmine for uni students. And our mission, well, it's to pull out those key nuggets, demystify the whole thing, and help you really get what risk is, why managing it is non-negotiable, and how it's actually done. So whether you're prepping for a meeting or just curious, you're definitely in the right place. Okay, so we all kind of get what risk means generally, right? But in finance and business specifically, it's got this formalized definition. It underpins pretty much every big decision. So how does the financial world define risk exactly, and why is managing it just so crucial?
Well, yeah, in the financial sphere, risk management isn't just a one-off check. It's defined as a continuous, proactive process. It's really about systematically identifying, then assessing, and then controlling things that could potentially disrupt a business or a project. And here's something important. A lot of people see risk as purely negative, something you just avoid. But actually, it's a natural part of every single business decision. I mean, real innovation often involves taking smartly managed risks. Think about a bank, for instance. Before they give out a loan, what do? They check your credit history thoroughly. That's classic risk management right there, trying to anticipate and, well, prevent defaults.
That makes sense. The proactive part, not just reactive. That really clicks. But let's get to the core. Why is it so absolutely essential? I mean, for survival and even for thriving, you hear small businesses say they don't have the resources for this kind of formal process. Is that fair? Or is this framework still vital even for them? Am I oversimplifying?
No, that's a great question. You're spot on. It is crucial for everyone, just maybe scaled differently. It's fundamental for, well, several big reasons, whether you're a tiny startup or a giant multinational. First, yeah, it helps avoid financial losses. Spotting problems early is key, sometimes before they even fully happen. But it's more than just stopping losses. It actually helps businesses make better decisions because those decisions are based on, solid risk reports looking forward. It shifts you from constantly putting out fires to actually planning ahead. Third, it builds stability, helps companies ride out crises instead of, well, collapsing. Fourth, it's about protecting assets and people, your buildings, your ideas, and critically, your employees. And finally, yeah, compliance. Good risk management keeps you on the right side of the law, avoids fines, protects your reputation. It helps you navigate all those rules with confidence.
Okay, in the scope of it. It's definitely not just about the money, right? The guide we looked at, ABD Sirs knows, they make it really clear it covers a lot more ground.
Absolutely. The scope is way broader than just the bottom line. You've got financial risk, sure, that's losses from investments, currency swings, interest rate changes, that sort of thing. But then there's operational risk. That's about day-to-day stuff going wrong, systems failing, human mistakes, supply chain problems. Strategic risk, that's making bad business calls, like picking the wrong market to enter. Compliance risk, pretty straightforward, failing to follow the rules. And then there's reputational risk. This one's huge and sometimes overlooked. It's damage to your public image, losing trust. Think about, say, a food company. If they cut corners on hygiene, maybe it gets out, bad press. They're hit with compliance and massive reputational damage, maybe at the same time. So it really makes you think, doesn't it? For your own work, your own projects, are you considering all these angles of uncertainty?
I'll tell you.
Or just, the financial ones?
We've got a solid foundation now. That's helpful. But the details really matter when you look at specific types of risk. I was reading through the material, and two terms, product market risk and capital market risk, they sort of jumped out. They sound related, maybe? But the guide stresses they're distinct. What's the main difference we should get straight away?
Yeah, they are distinct, definitely. Though, like you said, they can influence each other. Let's tackle product market risk first. Basically, this is the risk a company faces when its products or services just don't land well in the market, don't perform. And the causes, oh, there are loads. Customer tastes change, new competitors pop up, maybe there's a price war, technology shifts. It can also happen if you launch without really doing your homework, your market research, or if you ignore what customers are saying, or your pricing is off, or your products just feel old. Like, imagine a company still pushing only traditional watches when everyone's buying smartwatches. If they don't adapt, sales are going to tank. That's product market risk right there. How do you control it? You've got to really get your customers, watch the market like a hawk, keep innovating, and build a strong brand people trust. It's not just having a good product, it's about keeping it relevant in a market that's always changing. That's the tricky part. Okay, then you've got capital market risk. This one's different. It's the risk of losing money because of broader shifts, changes in the stock market, interest rates going up or down, the whole economy taking a hit. This mostly affects investors, banks, companies dealing a lot with financial assets, shares, bonds, mutual funds, things like that. Key bits here include equity risk, losing money because share prices fall, interest rate risk changes affecting bond values or loan costs, foreign exchange risk losses from changing currency rates, and liquidity risk, which we'll dig into more, but it's about being unable to sell investments quickly without taking a big loss. A simple example, an investor buys shares at, say, 1,000 rupees each, then the market crashes and the price drops to 600. That 400 rupee loss per share, that's capital market risk. Managing it usually involves, well, diversification, spreading your investments, keeping an eye on those big economic trends, investing for the long haul, ideally to ride out the bumps, and using risk analysis tools. But, even long-term strategies aren't foolproof. Big market shocks can change everything.
Okay, those are two big ones. Product market risk, capital market risk. But knowing the types is one thing. How do you actually spot these problems brewing before they blow up? The sources talk about risk indicators, like early warnings. What are we actually looking for there?
Exactly. Risk indicators are just like those warning lights on your car's dashboard. They're early signals that help companies see trouble coming before it gets serious. They flag that something might go wrong down the line, meaning you need to act now. For instance, maybe a company's sales are dipping month after month. And at the same time, customer complaints are ticking up. Those are pretty clear indicators. They warn you about potential financial trouble or maybe issues with your market position. Other common ones: a steady drop in profit, lots of employees leaving suddenly, high turnover, projects constantly missing deadlines, bad press or negative buzz online. Why are they so important? Well, they allow for early detection. Management can jump in quickly, take action, and potentially save the company from huge losses or even, failure. And here's an interesting point. Often, it's not just one indicator. It's when several different, maybe small indicators start popping up together. That convergence often signals something bigger is brewing. Like a small revenue dip plus slightly higher staff turnover might seem minor alone, but together could point to deeper operational problems.
Right, connecting the dots. And speaking of spotting trouble, liquidity risk came up earlier as part of capital market risk. But the sources also highlight it separately as, well, a really crucial risk on its own. It seems like one of those things people ignore until it's way too late, right? Can you unpack that one for us? Why is it so vital?
You're absolutely right to flag that. Liquidity risk is basically the danger that a company or even an individual just doesn't have enough actual cash available to pay its immediate bills or cover urgent costs. It also pops up when you have assets, maybe valuable ones, but you can't turn them into cash quickly without selling them for way less than they're worth. There are kind of two main flavors: funding liquidity risk, that's just not having the cash for your short-term debts like payroll or paying suppliers. Then there's market liquidity risk. That's when you can't sell an asset fast in the market without dropping the price significantly. Think trying to quickly sell a unique building versus selling shares on a major stock exchange. Imagine a company owns a big building, maybe worth 1 crore rupees, but they urgently need 5 lakhs rupees tomorrow for salaries. If they can't sell that building fast or get a quick loan against it, they're facing a serious liquidity crisis. And it's vital because, well, it can cause chaos. Delayed payments, damage to your reputation. It can even lead straight to bankruptcy. It really underlines that old saying, assets are great, but cash is king, especially in emergencies. And what's really interesting, as you hinted, is how these risks interconnect. Like a sudden market crash, that's capital market risk, could hammer the value of an asset, making it hard to sell quickly. Boom, you've got liquidity risk right there.
Okay, so we've looked at these individual risks: product market, capital, liquidity. But the revision guide really emphasizes this comprehensive view of risk, especially for financial institutions. That sounds like a massive job. What does that actually mean for, say, a bank or an insurance company or mutual fund?
Yeah, you've definitely hit on a critical point there. A comprehensive view just means looking at all the potential risks together, like a full 360-degree scan, instead of just focusing on one type in isolation. And it's particularly vital for financial institutions, banks, insurance firms, mutual funds, because, well, they handle huge sums of money, their operations are incredibly complex, and they face a whole web of interconnected risks every single day. Think about it. If a bank only worries about, say, credit risk people not repaying loans but ignores risks from technology failures or potential fraud, they could be blindsided by huge losses. These risks just don't stay in neat little boxes. The notes from ABEDSER actually list several key risk types for these places. There's credit risk, obviously borrowers defaulting, like a customer missing their home loan EMIs. Market risk changes in prices, rates, currencies. Stock prices fall, hitting mutual fund returns. Liquidity risk, like we just discussed. A bank maybe can't provide cash if too many people want to withdraw at once. Operational risk, this covers system glitches, fraud, simple human error. Maybe a tech bug causes wrong transactions, or there's a cyber attack. Legal and compliance risk, basically, breaking the rules, not following RBI guidelines, for example. And reputational risk, losing public trust. Maybe news of fraud leaks out and customers lose confidence. So how do they manage all this together? Well, typically they use specialized software, set up dedicated risk committees, run regular audits and compliance checks, do a lot of staff training, and crucially, they try to build a strong risk culture. That means every employee feels some responsibility for spotting and preventing risk, like everyone's part of the defense.
Okay, that makes sense. Recognizing all these risks together is key. But it still sounds like a huge challenge. Is there a practical way to approach this? The guide lays out a risk management process, like a step-by-step blueprint. How does that work in practice day to day?
It absolutely is a blueprint, yeah. The risk management process is essentially a clear, methodical approach that helps businesses find, understand, and then control their risks. The aim is simple. Make sure unexpected problems don't stop growth or cause massive losses. Turn them into manageable challenges instead. It generally breaks down into 6 core steps. First up, risk identification. This is where you brainstorm, basically. Figure out all the different kinds of risks you might face: financial, market, legal, operational, maybe even environmental risks. So a bank would be actively looking for things like loan defaults or the possibility of cyber attacks. Second, risk analysis or assessment. Okay, you listed the risks. Now, how serious is each one? Here you look at 2 things: the potential impact, how much damage could it do, and the likelihood. What's the chance of it actually happening? For example, if a really crucial supplier delays sending raw materials, your production might grind to a halt. That's a high risk if that supplier isn't very reliable or if they're your only source. Third step, risk evaluation. Now you compare the analyzed risk against the company's own appetite for risk. How much risk are they actually willing and able to handle? This is where data meets judgment. It involves making strategic choices about potential rewards versus the exposure. It helps you prioritize which risks need action right now and which ones can maybe just be monitored for a bit. Fourth, risk treatment or control. This is the action phase. What are you going to do about the risk? You've got a few options. You could avoid it, just decide not to do the activity that creates the risk. You could reduce it, put safety measures in place, improve processes. You could transfer it. Often this means buying insurance, like fire insurance for a factory. Or you could accept it if the potential impact is really small and fixing it costs more than it's worth. Fifth, monitoring and review. This is crucial. Risks aren't static, they evolve. Market conditions change, new threats emerge. So companies have to constantly check their risk plans, see if they're still working, and update them as needed. It's definitely not a one-time thing. And finally, step 6, communication and reporting. You need to share what you know. The risk team has to keep all departments, and especially top management, in the loop about risks, updates, and actions. Everyone needs to be aware and prepared. A great risk analysis is totally useless if it just sits on a shelf somewhere or isn't communicated to the people who need to act on it. I like the analogy. Risk is like fire. If you control it, it cooks your food. If you ignore it, well, it burns down your house.
That fire analogy is great. And that last step, communication and reporting, it really does sound incredibly important. The guide even breaks risk reporting down further into internal and external. What's the real difference there, strategically speaking? Why does that distinction matter for managing risk effectively beyond just ticking boxes for compliance?
Yeah, it's absolutely fundamental. Risk reporting is just the structured way a company shares information about risks. Who needs to know? When do they need to know it? Getting this right is critical because it fuels better, faster decision-making and makes sure everyone's aware of potential issues. It really helps build that culture of preparedness we talked about. So when we talk about internal risk reporting, we mean sharing risk info inside the company with managers, department heads, the C-suite executives. The main goal here isn't just telling people stuff. It's enabling them to take quick, informed action and make smart, agile, strategic moves. Like, say a factory manager spots a machine overheating. Reporting that internally, quickly, can prevent a major breakdown that could halt the whole production line. This kind of reporting might involve things like daily risk dashboards, more detailed monthly reports, instant alerts for urgent issues, and specific reports on operational or financial risks that need immediate tactical responses. Then you have external risk reporting. This is when companies communicate about risks to people outside the organization. We're talking investors, regulators like the RBI or SEBI, government agencies, sometimes even the general public. The purpose here is kind of threefold. First, yes, compliance meeting legal requirements. Second, maintaining investor confidence. Investors want to know you're managing risks properly. And third, demonstrating good corporate governance and responsibility. A classic example is a bank having to report its credit risk exposure to the Reserve Bank of India every quarter. That's mandatory external reporting. It often includes things like annual risk disclosures and financial reports, updates to stock exchanges, maybe reports on environmental or safety risks, or informing authorities about cybersecurity incidents. So if you tie it all together, you see that clear reporting, both inside and out, is what makes risk management real. It turns the theory into practical, informed decisions and actions, and it builds trust and readiness throughout the entire system the business operates in.
Okay, as we start to wrap up our deep dive today, it's really clear that financial risk management isn't just some, dry academic thing. It's actually a dynamic, totally essential toolkit for navigating the messy reality of almost any project or business. We've covered a lot of ground, from defining different risks like product market and capital market, digging into why liquidity is so key, understanding how big institutions need that comprehensive 360-degree view, and finally walking through that methodical step-by-step process for actually managing risk. It really is about being proactive, not just reactive, about preparing smartly for whatever might be around the corner.
And this whole discussion kind of leads to a final thought, doesn't it? How can you, listening right now, apply this same framework? Identify, assess, manage risk, not just in a big corporate setting, but in your own projects, maybe personal ones or professional tasks. What potential risk might you be accepting right now, maybe without even realizing it? And perhaps what's one small step you could take, maybe even today, just to start identifying them?
That's definitely something to think about on your own deep dive later. We really hope this conversation has given you a clearer, maybe more confident handle on financial risk management. Thanks so much for joining us on this deep dive.